For 5 minutes, please.
Thank you, Mr. Chairman. And I want to kind of go a little backward and back to the beginning of why we're here. We're here because the GSEs, frankly, helped fuel the crisis that we are in. And now a lot of folks in Washington are saying, gee, should we have an implicit government guarantee through the GSEs? Should we look for a different model? So one of the reasons that we're here is because covered bonds are a different model. And I know Mr. Skeet talked earlier and said that you don't think covered bonds are the only solution. What kind of capacity could a vibrant covered bond market create? Would it create enough of a capacity to replace what the GSEs are doing today? And we can start with Mr. Skeet, and if anybody else wants to comment.
Just very briefly, no, we don't think it will replace the GSEs. That's not. It's an additional tool. It's a logical tool. It's a tool that makes sense. Remember that, again, we asked earlier about limits on the amount you can issue. The UK guidance is about 20% of total assets. You can do a quick calculation. That's the upper limit that the regulator in the United Kingdom feels comfortable with the bank issuing. Beyond that, they will stop you or up the amount of capital you need to hold. You do the calculation, that's a good capacity. You can do a lot of term funding. But remember, net stable funding ratio is an important ratio for all financial institutions here on after, because regulators care about not just deposits and the amount of deposits, but do you have 5 and 10 and 15 and 20-year money out there? That's part of keeping banks safe and sound for the future.
If I could just add to that, Mr. Stivers. The U.S. Residential mortgage market for owner-occupied housing is now over $10 trillion outstanding. The covered bond market would develop slowly. It wouldn't be overnight because investors would have to get used to it, that the paper would have to be put out there. It is conceivable that the covered bond market might grow to 5 or 10% of that. That is, let's say, $500 billion, $1 trillion of paper. That is still smaller than the European market, but it would be a very significant market, a highly liquid market, and again becomes an important source, not the sole source, but an important source of funding for home mortgages, particularly as Fannie and Freddie shrink, and more specifically as their balance sheets would shrink.
I think you pretty much agree. I mean, it's an important tool. But we all need to understand we've got a lot more work to do. And maybe Mr. Skeet's right, and it's 20%, so it's $2 trillion, but it's not going to fix it completely, but it is a good tool, I think. I do have a question about the over-collateralization. So essentially, the 20% rule is basically how the European market manages that. You know, you've got 100% of loans to cover the 20%, well, whatever, 100% of the loans you haven't securitized to cover the 20% of loans you're allowed to, issue covered bonds against. Is that essentially correct?
It's getting quite complicated because of the way this net stable funding ratio is being introduced, because if you look at that, the over-collateralization portion of a covered bond has to be 100% funded from the senior unsecured market. So you've got whereas the mortgages themselves have to be funded 65%. So there are various calculations that need to be done. You know, the world is becoming a lot more complicated in future, but of course I think it'll become a safer and stabler place if we are allowed to do that. By the way, the FSA is a little bit vague about how it monitors it. It is specifically the UK that's done that. They've done the most work on this, but what they're looking at on an ongoing basis is the overall level of the collateral that's in the pools against the covered bonds. If it gets beyond a certain level, they get uncomfortable and they will increase the capital charge for those banks. So it's not a fire and forget. This is constant monitoring. It's proper supervision.
Great. And, Mr. Andrews brings up some good points, and Mr. Skeet talked about, I think you talked about in Norway, how some smaller banks have come together, but I believe you said they came together under a larger bank who, it was on the larger bank's balance sheet?
No, they created a third-party bank, if you like, which specifically took the assets from their members.
It was just a conduit.
Correct. It was a properly constituted bank, but it was set up for the sole purposes of taking in the assets of these lesser institutions.
Pooling and financing.
Pooling of the financing and then issuing. And they issued in the United States market, interestingly enough.
Great. That was the only other question I had. Thank you. I yield back the balance of my time, Mr. Chairman.